What up, peeps? Okay, let's hop into what does an excitable move mean? Okay, so basically, what we are doing with excitable moves and what we are really trying to see is where money is going. Okay, so I'm gonna pull this thing down, and you would basically depict this, okay, as an excitable move. Now, this would be an excitable move to the upside, okay? So what we would look at that as is we would look at it like this, okay? So we would have what would be called a low at the bottom down there. This would be considered our low, okay? And then at the top up here, we would have what would be considered our high at the top, okay? So now we would pull that over here. And with that, what that represents is obviously a low and obviously a high. Okay, so we see a low and we see a high that gets created. Now, when there is a low that formulates, all right, it usually is formulated by a valley. Now, what that means is we have a usually at the bottom down there, we have a consolidation that gets formed, okay? So usually there's some type of consolidation that forms, and that would be our contraction point. Now that thing can be very small like this, or it can be very like large like that, okay? So what we're looking at is a buildup of consolidation, and then after a contraction happens in the market, an excitable move goes. So or happens. So what you look at as contraction, right, is you look at it like a spring, all right? Whenever you get a spring and you coil up a spring, you're coiling it up, or you're smushing it down. And what it is it's a buildup. And then all of a sudden, when you let the spring go, what does it do? It springboards, it shoots out. Okay. Now that in the market represents either an excitable move to the upside or an excitable move to the downside. Okay. So whichever way that the market goes excitably is usually where the money is going. Okay. So when we see an excitable move, what is going on is the market is giving us an area in which we can follow. Okay. So remember, what we are is followers in the markets. Okay. Banks, institutions, and universities, they are the leaders. They're the ones who really move the market. It's not us. We can't move it. For the market to move, and I talked about this before, but 1 pip takes $10 million. Now, let me just show you the significance of that, and you'll see. So right here, this little cursor that we have here, the little thing that went to 1 right there, and it says 12.53, right? This is how you measure pips and stuff. And Santon has all the videos in there that you can actually watch things over in the new X station. But anyway, so you go from here, right, and you pull it down. That is 69 pips right there. Okay, so do you see how far I moved that? I literally moved it down to right there. Okay, that right there is 486, 4.86. Okay, so for that thing to move 1 pip, that thing just moved $69 million worth right there. So you can imagine what this is, how many that is. That's 22,139. So do you see the significance of what that means? Okay, so when you see a big excitable move, I want you to think a lot of money is moving in that direction. Okay, so when you see a lot of money moving in a certain direction, that means we will follow that direction. Now, what will happen is we will get a low that gets created, and we will get a high. Now, to the downside, it's the opposite. We will get a high that gets created, and then a low, it will happen. So it will be just like this, right? It'll go like this to this side, and you'll get that high, and all it will do is it will just duplicate, and you'll get a high that gets created, and then it will go and it will make a low. But either way, guys, it's still an excitable move, okay? And it's all formed by a contraction in the market, and that's how it works. So what then happens is we always have a retracement that happens every single time. Now, a retracement can go anywhere from right here to the excitable, like literally right there, and it's a hook. That's all it is. It's just simply a hook that happens in the market, and we'll go and we'll look at this on the actual market. So it hooks down like this, and a retracement can go anywhere from right here all the way down to here. This can be a retracement, okay? So this looks a little, this isn't necessarily like a perfect hook, like it's kind of harder to see that, but that's still a hook. It comes all the way up and it hooks over. That's still a hook. Remember, shift your paradigm. And it looks a little better whenever you have it here. It looks a little better right there, and it looks a little better there. Those are all hooks in the market. Now, what this is called when this happens, so we have a low and we have a high. What this is called here, this is actually called a, this out here, a higher low, okay? Because it is higher, right, than that low. It's higher than that low. That's called a higher low, okay? And this is kind of where you start to have your market contractions at and things like that. That's where the market kind of likes to build up. Now, sometimes it's very sharp. It literally goes up and it retraces right back around just like that. Sometimes it does that, okay? And then other times it's elongated. It takes a very long time for it to go left and right. It just does. And then what follows that is usually another excitable move. So I'm going to move this down here so we can keep it in there. This is all still a higher low. Okay. All this is still a higher low. And then we go in and we go and create what this is called is a higher high. Okay. And that is called a higher high. Okay. That is a higher high right up here. And these are both excitable moves. Now, my trading strategy centers around catching this big move and this big move and finding it in here, okay? So when we see that, that is what we're looking to find every single time. Now, I will draw you what it looks like to the downside over here, okay? So now this retracement up here like this, all right, so what that is, and let me move this up a little bit so it doesn't go out of the screen. Put it right there. And we're going to put that there. Pull this over to here. Pull that over to there. This, on that little hook over there, is actually called a lower high. That is what this is called, a lower high right here. Because it is lower than that high. So see that? And then what we have that happens after that is the next excitable move usually. And this is called a lower low. Okay. So lower low is what we have happen over here. This would be called a lower low. So what we're looking for is we're looking for excitable moves, which are these. And we're looking for retracements, which are these, which usually consist of a type of contraction. And we are looking for excitable moves, which is the next area, which is the higher high. And then on downtrends, this is what would symbolize a downtrend. This is what would symbolize we would call an uptrend, which is considered of highs and higher highs, and downtrends consist of lows and lower lows. Okay. Sorry, let me rephrase that. Uptrends consist of higher lows and higher highs, and downtrends consist of lower highs and lower lows. That's what they consist of, okay? But they're all centered around an excitable move. They're always centered around an excitable move. And the excitable moves mean money. That means the market is usually moving in that direction. Okay. It has a very high potential to move in that direction. Doesn't mean it always will, just means that's what it's essentially looking at doing. So let's go and look at some of our examples up here in our chart. Okay. So when we look at this, okay, we can delete that off of there and clear this off of here so it's not on the screen. It just bothers me. So when we look at this, all the things that we've talked about already, we've talked about volume, reading volume, we've talked about candlesticks, support and resistance, those kind of things. So hopefully what you're looking at when you're doing things like, for instance, this example right here, right? when you look at this and you put this here, this would basically be a support. Like right in here would be pretty much what we would consider a support for this zone right here. Okay, this would be considered a support. All right. Now, we can see the market is contracting from left to right. We can see that. We can see it here sitting side to side. We can see a little push up there, and we can see it contracting right there. Okay. These are things that I want you to pay attention to. Now, what happens is it breaks our support right there. All right. But what actually is going on, guys, is right here we get a high, and this is a low here, and that is actually a lower high right there. So if we go and we name this right for what it is, that's a high right there, and then we come down here, and this becomes a low right here. This is our low in there, and then what we get is we get a lower high. That's a lower high that formulates right there. So see how in the market now, in that same example, how I just drew to you, that's how that looks right there. Just like that, okay? And as you see, if you go and duplicate this, that goes in to form the what? The lower low. That goes in to form the lower low. That's this. That's that exact example we just drew, okay? A high, a low, a lower high, lower low. That's how you read that. Now, like I said in one of the videos, what was once resistance, what was once support now becomes what? Resistance. The market retraces just like this, okay? It retraces. So if we duplicated this, this is the retracement in there, okay? All in here is the retracement. All of this is the retracement, okay? It has to stay below the high, okay? That's what it needs to do. It needs to stay below the high over here. So this is a retracement, and then what it does is it goes and it creates a lower low like that. So see how it goes and creates a lower low? See how it goes and creates a lower low all the way down here? That is a lower low. Now the market consolidates, and what does it do? Boom! Excitable move to the upside like this. Big excitable move to the upside, okay? This goes up. This is a low now, right here. Though actually it goes and creates a lower low is what it goes and creates, okay? That is completely fine, okay? I want you guys to understand that's completely fine. Lower lows can be created and then can extend all the way into a high. You would just call this a low. Like it's fine to call that just a low. As long as you are understanding what I'm showing you, that this is a downtrend, right? High, low, lower high, lower low, lower high, lower low. That's what's going on. It goes and it does a trend switch. Okay, this actually trend switches. How does it trend switch? Because it goes and breaks over here, this high right here. It goes and breaks that at that area. Now that's a clear trend switch right in there. There's smaller ones, but I'll get into that later. But that clearly switches the trend right there. You can easily see that, okay? And what happens is we go and we get a high that gets created like this. This would be a high that gets created, all right? And then there's this excitable move that goes to the upside there. Now what happens, guys, is we get a basically a contraction point. Boy, that was not a contraction. That thing was tripping. That's what that was doing. This is basically the contraction point right there. And then we get this pullback right in here. And this is our higher low right here, okay? So that would be considered our, oh shoot, I don't want me to do that. That would be considered our higher, if I could spell it sometime this year, our higher low. Good Lord, I'm over here really contemplating my life right now. This would be considered our higher low, okay? So this is higher than our last low over there. This is our trend here. So this is our low here. Yes, it says lower low because in relevance to this over here, this is still low because we can see low, high, higher low. And then what happens after that is we extend up into a higher high as of this. That's how that happens. Now, every, this is essentially what's going to happen with the markets when this happens, okay? That's essentially what is going to happen. You're going to have a high that gets created a low, a lower high, and usually if it creates a lower high, it's going to go make a lower low. Okay. Usually if it creates a higher low, it's going to go make a higher high. It's not guaranteed. Okay. It's not something that is guaranteed, but that's usually something that we can anticipate to happen. That's ideally what we can usually anticipate. Whenever that happens. And this is what we are following. This is the formula. Now, you guys are going to realize that on the next videos and how I do everything, you're going to see really what we're following every single time. That's what we're going to be following. Okay? And remember, excitable moves mean money. They mean that's usually where the money is headed to. It does not always mean that that is where it is going every single time. Okay? But that's usually, we can almost count on that almost always, of where the money is going. Now, there's more things that we're going to get into, that we're going to learn, that are going to make sense. But what I need you guys to do now is practice finding the highs and the lows and then the retracements, okay? So that's like your lower highs, that's like your higher lows. So you find the highs and the lows and see if you can find that excitable move and see if the market just moves excitably in one direction. Look for it and then try to go find an area where you're like, okay, there's an excitable move to the downside. Now let's see if it's where it stops at. It usually is, it stops with a bullish and bearish candlestick, or a bearish and bullish. It doesn't matter which one it's which. It's just, that's usually how it stops, bullish and bearish. And then it retraces, it gives us a hook. That's what we look for, is we look for that market hook. And then we get another usually excitable move, okay? We go to the upside, we find an excitable move, we find bullish and bearish candlesticks, we find that hook, we find that square, that contraction, that consolidation, and then usually it's formulated by another higher high. That's just usually what happens in trading, guys. Just plain and simple, that's how it goes. So I want you guys to spend some time on that. Spend some time learning that. Spend some time doing that. Put some effort into that. Put some energy into looking for those things. Any time frame, it doesn't matter, okay? Find your valleys, find your peaks, find those areas in the market, look for them, identify them, and then look for excitable moves, okay? Remember, crawl, walk, run. This is a step-by-step process of what we are doing right now together, okay? And these are the very basic things that you guys need to know thus far in getting into the really complex stuff, okay? So on the next video, we're going to learn about one of my favorite tools, okay? It's oh my gosh, it's amazing. So we're going to get into that next. So I hope you guys enjoyed the video and see you guys on the next one.